There are a whole series of life insurance policies that have guarantees embedded in them, and we're not willing to bet our policyholders' capital on rates going up in the future. So we're not doing what's called mean reversion pricing. So there are some policies where our premiums are higher than others, hence we're not selling a lot of those kinds of policies.
And that's because you don't think rates are likely to, I mean, you don't think it's likely, or you're just not willing to bet any money on it?
You know, we look at where the capital markets are, and it's to bet against the markets is not kind of what we do.
So when you look at your competitors who have products like that, do you say to yourself, 20, 30 years from now, they're just not going to be able to make the payments?
Oh, no. I think the life insurance industry is a very financially strong industry. But if you just take a look, you've seen companies have to take reserve additions because of pricing decisions they've made in the past. So we're trying very hard to be honest with ourselves about where rates are today. So the biggest product that we sell is permanent whole life insurance.
Right. We were just talking about whole life during the commercial break.
We have our dividends that are a little bit different than other companies because we don't just own a portfolio of bonds. We own businesses. And those businesses help us pay a better dividend to our policyholders.
Can you just make the case for whole life just for 1 second for the audience? Because I'll tell you why. I had a conversation once with Warren Buffett about this, actually, and he said, term life yourself, and then hopefully you'll, at some point in your life, you'll get to be able to be self-insured.
Yep.
That should be the goal.
Meaning you have enough money that you don't need the insurance to cover it.
So the richest person in the world is, in fact, self-insurable, right?
But the rest of us?
But for most people, the ability to have instant liquidity at a time when your family needs it, you may have an estate tax obligation that may be needed. You may own a closely held business, so you need to kind of think about the transfer. But most importantly, term is wonderful for getting mortality protection when you're young. It's very inexpensive because the chance of dying young is pretty low. The day the term policy expires and you still want to take care of your children or grandchildren or your wife or your husband or your partner, permanent insurance has a real place. The earlier you buy it, the lower cost it is, because you're simply spreading that mortality cost over a longer period of time. Our sales of whole life insurance were up 24% in the first 6 months this year. We've grown at a 15% compound annual growth rate for 11 years.
There's a way to do it where you don't get ripped off. And I mean, the perception was for years that whole life was not economically viable. But you can do it now where even if you, and I'm talking about like a second to die, even if, we said this off camera, if you lived to 94, you're still getting a 3 or 4% return on what the policy is.
But how many people are?
You don't want term life to pay off. Like there's times where I'm like, I don't even want any freaking term life because I'm not even admitting the possibility that it's going. I mean, it's like the worst thing in the world. It's like that's my benefit.
Yeah, but we have kids. Everyone.
I know. I've got it. I get it, and I've got a lot of it, but I hate it.
So this is why you work with a good financial advisor. And MassMutual's really interesting, right? Policyholder-owned company. So we have one alignment. It's a very long-term business.
But on the whole life policies, how many people are now, especially given the lack of savings that people have in this country, where they're actually coming back to you and saying, actually, I need that money?
Yeah, one of the great things about whole life insurance is it builds cash value that you can use. So we have something around 11 or 12% of our cash value has been borrowed, and that's what it's supposed to. It's a whole life policy.
Right.
It means you need to send your kids to college, you can borrow some money. We've had great American businesses. Disney was an example where the cash value in a life insurance policy helped get that company going.
Roger, what did the insurance companies do years ago that gave whole life a bad name? What did they do? They didn't give competitive rates. They tried, the commissions were too high, or they did something because it has a really bad rap.
Again, you go way back, right? Yeah. When Volcker pushed up interest rates, and portfolio products were yielding lower than short-term products, people borrowed against the cash value and put it into money market funds. So that was one thing that kind of structurally changed how the industry worked.
But did insurance companies
rates were to go up sharply again, would you be in a bad position if you were in one of those?
You know what? We got religion about asset liability management like every other financial institution, so we're much better now at matching our assets.
Can I ask you about underwriting? Because one of the other things that's happened is technology. Even in the last 12 months, 24 months, so much of the underwriting is now being not just done by a human being, but also you're being helped in large part by algorithms and AI, right?
Yeah. So MassMutual's invested a lot to disrupt the manufacturing side of life insurance. And by the way, no normal person thinks about how life insurance works until you have to go through the process. To take 20 or 30 days to have someone show up at your house and put you on a scale at the start of a process that goes downhill from there. We want to change that. So this past month, 3 out of 4 of the policies we underwrote went through machine underwriting without having to have an underwriter involved.
What does it mean? Machine underwriting means what?
It means we are using algorithms to underwrite mortality so we can issue policies in a day or two versus in 20 or 30.
So you don't need to come do the health check on me. You can figure out statistically what the odds are that I'm going to die.
Correct, especially if you are younger and healthier. Big policies, older people, I think we're going to have more human underwriting for a long time. But the whole push to using artificial intelligence and machine learning in everything is coming to our industry as well.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.